Hello everyone. Once again I welcome you all in our new question discussion. In this video we'll take a very good question from consolidation chapter which was actually asked in the last attempt, that is in November 2023 exam. Lot of doubt came about this question after exam. Then once the ICAI has given suggested solution for this question, then also a lot of doubt came. Let us discuss this question. In this discussion, first I will take the viewpoint of ICAI. Then I will give my viewpoint as per concept is concerned. Let us first read the question. What is the question? The extract of balance sheet of Hamel Limited and its subsidiary Slick Limited as on 31st March 2003 are given below. Hamel Limited, Slick Limited. You can see property, plant, equipment, intangible asset, investment, inventory, financial asset, trade receivable, cash and cash equivalent, equity and liability, equity share capital, other equity, non-current liability, financial liability, borrowing, current liability, financial liability, short-term borrowing, bank overdraft is the short-term borrowing, trade payable. Then total equity and liability is given. Then they have given in PP, there are two PP, plant and machinery and furniture and fittings. Intangible asset represent goodwill, and you can see we have goodwill given in the balance sheet of subsidiary company. Means there was some goodwill in the balance sheet of subsidiary company. Other equity, general reserve, retained earning, borrowing, they have given 8% debenture of ₹100 each in the books of subsidiary company. Chalega? Yes sir. Then what they have given? Hamel Limited acquired 20,000 equity shares of Slick Limited on 1st April 2022. So if I am saying 20,000 equity shares, out of how much? Out of total equity shares 50,000. So 20 divided by 50 means can I say it become 40%. So they initially acquired 40% of equity shares at a cost of rupees 2,40,000 and further acquired 17,500. So 17,500 divided by 50,000. How much it is coming? You can see it is coming 35%. So again they acquired 35% on 1st October 2022 at a cost of rupees 1,92,500. Means it is a question of step acquisition. Correct. And the date of acquisition will be 1st October 2022. Correct. Yes sir. The 8% debenture of Slick Limited include debentures held by Hamel Limited of nominal value of rupees 35,000. Means can I say Hamel Limited has also invested in the debenture of Slick Limited. It means this investment whatever has been given, correct, what this 6,25,000 includes some investment in the debenture of Slick Limited, and they have purchased at a cost of what? These were acquired by Hamel Limited on 1st Jan 2022 at a cost of rupees 84,000. So can you say in these what is the nominal value of debenture? Nominal value of debenture is 35,000 which was acquired at rupees 84,000. So this investment will include how much? This investment will include 85,000. Understood this point? Correct. This is also a new point given in the question. Simple, but it is as simple as one type of intercompany balance. To intercompany balance need to be cancelled. Yes sir. The retained earning of Slick Limited had a credit balance of 75,000 as on 1st April 2022. On that date, balance of general reserve was 50,000. Of course, this is the opening balance of retained earning and general reserve has been given. Slick Limited had paid dividend at the rate of 10% on its paid up equity share capital out of the balance of retained earning as on 1st April 2022 for the financial year 21-22. The entire dividend received by Hamel Limited was credited in SOPL, but in this question, what is not given? The date of payment is not given. So payment date is not given. So of course, can I say whenever payment date is not given, we need to assume it was paid on which point of time. So let us understand what ICAI has taken assumption and whether there is a possibility of alternative assumption or not. As per the resolution dated 28/5/2023, Slick Limited had allotted bonus shares at a rate of 1 equity shares for every 10 shares held out of its general reserve. The accounting effect has not been given. मतलब कि bonus shares were declared by Slick Limited on 28/5/2023, but till now no journal entry of bonus shares has been done. Now, if you have done the journal entry for bonus shares, so can you say the bonus share journal entry will be, because it has been given out of general reserve, so journal entry will be general reserve account debit to equity share capital, general reserve account debit to equity share capital. But that journal entry has not been done. Trade receivable of Hamel Limited include bills receivable of 2 lakh drawn upon Snake Limited. Out of these 50,000 have been discounted with the bank. Means out of 2 lakh, trade receivable of Hamel Limited include BR of 2 lakh drawn upon Snake Limited. Out of these, bill of 50,000 have been discounted with the bank. So bill has been discounted with the bank. Okay sir, so we need to cancel these also. Yes sir, correct. Then during the financial year 2022-23, Hamel Limited purchased goods from Sikh Limited of rupees 25,000 at a sale price of 30,000. Correct? Means at a profit of 5,000, 40% of these goods remain unsold on 31st March 2003. So it is a upstream or downstream transaction. So Hamel Limited purchase. So it is an upstream transaction. And can I say annualized profit will be how much? 5,000 into what? 40% remain unsold. So 5,000 is the total profit. So 5,000 into 40%, how much? 2,000. So this become unrealized profit. And this is a which transaction? Upstream transaction, because parent company has purchased from what? Subsidiary company. So this need to be also eliminated. On 1st October 2022, machinery of Sikh Limited was overvalued by 20,000, for which necessary adjustment are to be made. To they have given the fair value loss only to on the date of acquisition. It was overvalued. So we should decrease machinery by 20,000. So they have given the amount of fair value loss. The appreciation is charged at a rate of 10% per annum. So we need to also provide post acquisition depreciation effect. Of course, if there is a loss, there will be some saving in depreciation. Yes sir. The parent company, that is Hamel Limited, has adopted an accounting policy to measure NCI at fair value quoted market price, applying Ind AS 103. Assume the fair value per equity share of Sikh Limited at 11 on the date when the control of Sikh Limited was acquired by Hamel Limited. So of course we need to measure NCI by fair value method. For that purpose, they have given fair value of equity shares of Sikh Limited of rupees 11 per share. You are required to prepare consolidated balance sheet as per Ind AS of Hamel Limited and its subsidiary Sikh Limited as at 31st March 2003. Can we start? Now, first let us understand the question. So you can see on 1/4/2022, on 1/4/2022, they initially purchased 20,000 equity shares, that is 40% at rupees 2,40,000. Then on 1/10, they again purchased 17,500 equity shares, that is 35% at 1,92,500. They have given opening balance of retained earning, how much? 75,000, and opening balance of general reserve, how much? 50,000. Got this point? Correct. Then they have also provided some information. Nominal, they purchased nominal value. They purchased some investment in Sikh Limited whose nominal value was 35,000 and the cost price is 84,000 on 1/1/2022. This information is also given. On 20th Feb, they have subsidiary company has given bonus shares in the ratio 1:1, 1:10, but no effect of this has been given till now. On the date of acquisition, machinery was overvalued by 20,000 and the rate of depreciation is 10%. NCI is measured at fair value. Fair value of equity shares of subsidiary company is 11 per share. And they have given final dividend paid. Now final dividend paid at a rate of 10% they have given. You can see final dividend paid. So final dividend was paid at a rate of 10%, but the date of payment was not given. So of course we need to find out when it is paid. Now we can take two assumptions. Either it is paid before the date of acquisition, or we can assume it is paid after the date of acquisition. These two assumptions will prevail. However, from my point of view, if you ask my intention, so I will always assume, if the question is silent, I will always assume it is paid after acquisition, after the date of acquisition, when the control is when the control is obtained. So as per my assumption, I will take this because the question is silent. Correct now. But the question, ICAI has taken one assumption in this, it was paid before the date of acquisition. Final dividend was paid at a rate of 10%. Means can I say it will be received by the parent company only to the extent of 40%, only to the extent of 40%. It will receive by parent company only to the extent of 40%. But if you take the assumption that it is paid after the date of acquisition, then parent company will receive 75%, not 40%. So this assumption may vary. So of course this assumption, I will not say it is not correct. Of course this is correct, but if you ask my viewpoint, I will always consider the assumption कि it has been paid after the date of acquisition, means on after 1st October 2022, but we'll take the assumption as given by ICAI only. Chalega. This is the entire question. This is the entire question, correct? Now first we'll do fair value adjustment working note on 1/10/2022. So fair value loss is given 20,000. Fair value loss has been given 20,000. On this we'll save some depreciation, which is nothing but 10. The rate of depreciation is given 10% for the post acquisition period, and the post acquisition period from 1/10 will be 6 months. So you can see we have given the effect of saving in depreciation. So net amount on the date of consolidation will be 19,000. The first working note, no doubt. Then we'll do analysis of profit. So analysis of profit, retained earning and general reserve. So first we'll find out closing balance. Closing balance of retained earning is given how much? Check karo. The closing balance of retained earning, if you go to the balance sheet, the closing balance of retained earning has been given how much? You can see closing balance of retained earning is 2,50,000. Closing balance of general reserve is 1,25,000. That is only taken. You can see 2,50,000 and 1,25,000 we have taken. Then opening balance of general reserve and retained earning is given. The opening balance of retained earning is 75 and general reserve is 50,000. So you can 75,000, 50,000 minus. So this will become profit after appropriation. Profit after appropriation we have done, and profit after appropriation. Profit after appropriation is profit after dividend and profit after bonus shares. Correct? Yes, sir. So 1,75,000, 75,000 will come. Then Kenneth will nullify dividend and bonus shares. Correct? So first we'll do plus final dividend paid. Final dividend paid, it is paid by subsidiary company, so it will be 10% on their capital. Their capital is 5 lakh, so 10% 5 lakh, 50,000 will be added back. So this will become profit for the year before dividend. Before dividend. Why we are calculating profit before dividend? Because can I say we need to apply time adjustment for pre and post acquisition profit only on the net profit is which is earned during that year. Now of course we should also add back bonus shares, but no journal entry has been done. So if no journal entry has been done, there is no need to add bonus shares. So you can see plus bonus share. If the journal entry would have been done, then we would have added. But since the journal entry has not been done, so there is no need to add bonus shares. Understood? Correct? So you can see no effect has been given for the bonus year. So this become profit for the year, and this will be allocated in pre and post acquisition profit based on the date of acquisition. So 6 months is pre and 6 months is post. So you can see 6/12 we have done, and this become pre acquisition profit and post acquisition profit. Analysis of profit you have understood? Correct. I think this also you have understood. Now coming to statement of net asset. Statement of net asset. So of course we'll start with the date of acquisition. Date of acquisition is 1st October 2022. Then post we write down 2 columns, retained earning and general reserve, and the date of consolidation we write down. Correct? Now first we write down equity share capital. So equity share capital is given 5 lakh and 5 lakh. But can you say this equity share capital is before bonus shares? Before bonus shares. Correct? So I need to explain thoda sa point about bonus share. Just try to understand. If the journal entry of bonus share would have been done, so your journal entry will be general reserve account debit to equity share capital. Means your equity share capital will increase by the amount of bonus shares, which is nothing but, can I say the amount of bonus shares is what? 5 lakh they have said in 1:10. So divide by 10, so it is 50,000. So you will pass the journal entry with 50,000. Just try to understand what I am saying. So of course this journal entry will be done. So if you want to pass this journal entry, and they have said that bonus shares has been given from pre-acquisition general reserve, so your pre-acquisition general reserve will reduce and your pre-acquisition equity share capital will increase. So ultimately what you will do, you will increase your general reserve on this date and you will increase equity share capital on this date and decrease your general reserve on this date. So ultimately no effect. So what I will just suggest you, whenever the bonus share journal entry is not done, so it is very simple from examination point of view. Ignore the entire bonus year adjustment. If you ignore the entire bonus year adjustment, the answer will remain same, and that is the only concept, because we know that whenever bonus shares are issued, it will not affect the net asset before and after the date of acquisition. Understood? It will not affect the net asset. If bonus shares has been declared from pre-acquisition reserve, so it will not affect the net asset on the date of acquisition. If it has been declared out of post-acquisition reserve, then also it will not affect the net asset after the date of acquisition. So I will say ignore the entire transaction, or you can, if you want to go as per ICAI solution, I will show that also. But can you say this 5 lakh is before bonus year? This much you understood? Yes, sir. Now retained earning. Can I say on the date of acquisition will be opening balance. Opening balance is how much? That is 75,000 plus pre-acquisition profit is how much? 1,12,500. That only we have written 1,87,500. Correct. Then post-acquisition is how much? 1,12,500. That only we have written 1,12,500. Then general reserve same will do. Opening balance is how much? 50,000. And pre-acquisition 37,500. So how much it's coming? 87,500. We have written 87,500, and the post-acquisition is what? 37,500. This becomes the entire effect in the net asset. Correct. Now we'll find the total. Total will come. This total will come. You can make a total of this. Understood this point? Yes, sir. Now we'll do final dividend paid, because dividend has been paid before acquisition. Because dividend has been paid before the date of acquisition. So can you see it will affect the net? It will affect the net asset on the date of acquisition. So net asset on the date of acquisition will be reduced by the payment of dividend, and therefore we have done minus final dividend paid 50,000 and 50,000. This point have you understood? So initially we have added to calculate analysis of profit. We have added. Now we are deducting on the date of acquisition, because can I say it will reduce the net asset on the date of acquisition, because the payment has been done before the date of acquisition. Payment has been done before the date of acquisition. This point have you understood? Correct. So when you have done the journal entry, what journal entry will do for this? The journal entry will what? Equity dividend account debit to bank. Equity dividend account debit to bank. Correct. And then it will be retained earning account debit to equity dividend. So first we have added to retain earning. Why we have added to retain earning? To find out the profit for the year, and the payment has been done before the date of acquisition. So can you see it will reduce the net asset on or before the date of acquisition. Therefore we have deducted final dividend on the date of acquisition. This point have you understood? This point? Correct. However, in ICAI solution they have deducted from this only. You can deduct from this also. 87,500 minus 50,000 you can do. But can you see we can do in this way also? Ultimately the answer will remain same. So minus final dividend paid. Now if you want to give the effect of bonus shares, what you will do? Can you just try to understand? You will deduct general reserve on this date, and you will increase your equity share capital on this date only. So ultimately no effect now. If you want to give, otherwise ignore. If you want to give, otherwise ignore. Means if you want to pass journal entry of bonus shares, so that will be done. That is given out of pre-acquisition general reserve. Are you getting what I am saying? So your pre-acquisition general reserve will reduce, and your pre-acquisition equity share capital will increase. Ultimately, it will not affect the net asset on the date of acquisition. That only I have done. I have totally ignored the bonus shares adjustment. So normally I will just give a concept that whenever bonus shares adjustment has been given and no journal entry has been done, ignore the entire adjustment from the point of view of consolidation chapter. Understood? Yes, sir. Then we'll do plus minus fair value adjustment. Plus minus fair value adjustment is what? For PP, it is minus 20,000 loss as per working note number 1, and there is a saving in depreciation. So plus 1,000, 19,000 will be the net effect. Understood? So this become INA. This will become INA. This much have you understood? This much you have understood? This become INA. Correct? This become INA. Whatever we want. Now, just try to understand. Can I say, everyone? When I am saying INA, so what we have done? Equity share capital. We have used equity approach. So equity approach means what? Equity share capital plus reserve and surplus is nothing but total asset minus total liability. Total asset minus total liability. So can you say when we have used this approach to find out net asset, this net asset will be including goodwill in the balance sheet. So there was some goodwill in the balance sheet of subsidiary company. So can you see this INA will be inclusive of goodwill? This INA will be inclusive of goodwill. My question to you are, when we calculate fair value of INA on the date of acquisition as per Ind AS 103, it should be including goodwill or excluding goodwill? Of course, it should be excluding goodwill. Of course, it should be excluding goodwill. So from my point of view, minus goodwill होना चाहिए. From minus goodwill 75,000, and this actually become INA excluding goodwill. This become INA excluding goodwill. But ICAI has considered this. ICAI has not considered this. I will just explain you at the end. I will also take this only. Let us take this. But I will explain what is wrong in this, taking this point. Means I will just give you the effect of this conceptually. So let us first take INA including goodwill 7,05,000. 7,05,000. This much you understood? This much you understood? Bolo. Once ignore this. Once ignore this. Correct. Up to this, any doubt? No doubt. Now let us come to calculation of goodwill or gain on bargain purchase. So we will first find out fair value of consideration paid on the date of acquisition for 35%. It is given the question 1,92,500. Then we'll do fair value of previously held equity interest, because when we apply step acquisition as per Ind AS 103, it should be remeasured at fair value. So we'll take the fair value of previously held equity interest. It is 40% of 50,000. So 40% of 50,000 will take, and the price per share is 11. Price per share is 11. So this will become what? Fair value of previously held equity interest. Fair value of previously held equity interest. Then they have asked you to take fair value of NCI. NCI will be 25% because total is 75%. So 25% of 50,000 into 11. So 25% of 50,000 into 11. This becomes fair value of NCI. Fair value of NCI. So this become total. From this will deduct fair value of INA 7,05,000, and this will be the gain on bargain purchase. This will be the gain on bargain purchase. Understood? So this become gain on bargain purchase. Any doubt? Any doubt? This is the same answer is given in ICAI solution. Then I will come at the end. I will explain what is wrong in this. Am I right? Yes, sir. Then we'll find out remeasurement gain or loss. Remeasurement gain or loss. So fair value is what? 2,20,000. And what is the carrying amount? Carrying amount of previously held equity interest is given. So it was initially purchased at 2 lakh. It was initially purchased at 2,40,000. That become carrying amount. So there is a fair value loss. How much fair value loss? So fair value loss is how much? It is 20,000 loss. This 20,000 loss will be transferred to PL. It will be adjusted with the retained earning. So this point I hope you have understood. In this also there is some conceptual understanding I will take at the end. Means ICAI has done this only. ICAI has done this, but there is some conceptual point that I will come at the end. Understood this? Now other equity and NCI will calculate. So this balance will take from parent company. This balance will take from parent company, and this will take as per our previous working note. That is what? 1,37,500 for this. 1,37,500. Now we'll do share in PL. We'll allocate the share in profit or loss to parent company and NCI. So we have retained earning. How much retained earning we have? Retained earning is what? 1,13,500, and general reserve how much? 37,500. Correct? Let us allocate it. So you can see share in PL retained earning has been allocated 75% and 25%, and general reserve has been allocated 75% and 25%. This much you understood? Correct? Yes. Now there is unrealized profit. Already we calculated unrealized profit due to upstream transaction of rupees 2,000. So this 2,000 will be also allocated to parent company NCI in the ratio of 75% and 25%, because this is the profit of subsidiary company included in the stock of parent company. So this will be allocated to both parent and NCI, will be eliminated. So minus 1,500 minus 500, 75% and 25% we have done. Then remeasurement loss. This remeasurement loss will be entirely attributable to parent company, correct? Because this is due to step acquisition, correct? So this will be entirely deducted from retained earnings. So remeasurement loss minus 20,000 we have deducted, correct? Then there is one debenture. This was a new point. So you can see debentures was purchased at what point? Debentures was purchased at what price? 84,000, but the nominal value of debenture was 35,000 in the books of subsidiary company. Can I say this need to be cancelled? So it is as simple as the parent company has purchased the debenture of subsidiary company. In the group company, they have purchased their own debenture. So they have purchased their own debenture, so it will be cancelled. So they have paid higher price. So whatever higher price they have paid, that will be considered as loss on cancellation, and that loss on cancellation will be also transferred to PL. So how much extra amount they have paid? 84,000 minus 35,000, that is 49,000 will be the loss on cancellation of own debenture, we can say. And you can see I have done minus loss on cancellation, that is 49,000, and deducted from retained earning, and this become what? The total amount of retained earning, general reserve, and NCR, which will come in the balance sheet. Correct. Understood? Have you understood? Now balance sheet, of course we can prepare. PP will come book value plus book value minus fair value adjustment, that is 19,000. Intangible asset, there was some goodwill in the balance sheet of parent company, that will come. Correct. Financial asset, investment will come. So what we have done, first from this 6,25,000 we have done minus the cost price of investment. That was total cost price of investment, that is 40% and 35%, then minus 84,000, and in this will add the investment of which company? The subsidiary company. So this balance will come. I hope this point you have understood. Inventory will come, will deduct minus URP. Financial asset will come, and we should deduct the bills receivable. So you can see the total bill drawn was 2 lakh, out of which how much discounted? 50,000 was discounted. So whatever has been discounted, can I say that cannot be cancelled? So we can only cancel to the extent of bill which is not discounted. Out of 2 lakh, how much bill was not discounted? That was 1,50,000. So that will be cancelled. So you can see minus 1,50,000 we have done. Cash and cash equivalent. Equity share capital will come. Other equity will come. I will just inform there is some difference in this point as my regard, means as per ICAI solution. I think this all you can do. You can prepare. Now come to the point of variance, means what I say, what ICAI solution say. Now just try to understand what ICAI has done. They have done calculated gain on bargain purchase. Now one goodwill is appearing in the balance sheet. Of subsidiary company. Can we show that goodwill in the balance sheet of parent company? No. Means goodwill and gain on bargain purchase, either goodwill will come or gain on bargain purchase will come. Correct. So my point is that goodwill should be deducted from this 75,000. As how much? 75,000. Let's see. What was the goodwill amount? 75,000. So minus 75,000, that should be deducted. So 1,55,000 minus 75,000, this will become gain on bargain purchase. So from my point of view, gain on bargain purchase should be 80,000. That only we have done. I have deducted 75,000 from other equity. But in ICAI solution, they have shown 75,000 yahan par. Which from my point of view it is not correct. This should not be shown in the balance sheet of parent company. This should be adjusted with gain on bargain purchase. This was first point which you need to understand. First point, have you understood? I will say, chalo, they have considered fair value of INA. Including goodwill. I will explain why we should take excluding goodwill. But can I say either goodwill will come or gain on bargain purchase will come? Both cannot come in the balance sheet. So okay, but they have shown this 75,000 in the balance sheet, which is not correct from my point of view. Either gain will come or goodwill will come. So we should net off it. Let's see. If you would have taken this, means just try to understand, minus goodwill, sunna. If you have deducted minus goodwill from this, then what will be my answer? Check karenge. Just try to understand. Then this will be what? 1,92,500. This will be 2,20,000. This will be 1,37,500. This will be 2,20,000, and this will be 1,37,500. The total will be how much? The total will be 5,50,000. Now can you say from this which will deduct INA excluding goodwill, that is 6,30,000. 6,30,000, and the answer will be what? 550 minus 6,30,000, that is what? 80,000 gain on bargain, but same gain on bargain purchase coming. Means actually the concept is what? If you see the concept, so we should take fair value of INA excluding goodwill. However, the answer remains same. However, the answer remains same. Are you able to follow me what I am saying? Answer remain same. Means my answer is also what? How much gain on bargain purchase? My answer is also what? Gain on bargain purchase 80,000. Their answer is also what? Initially they have calculated 1,50,000, but from that goodwill should be deducted. Ultimately the answer remains same, but the presentation, whatever ICAI presentation they have given, that is not correct. Understood? So from my point, this is one area where they should correct it. Correct? So I will say you follow this only, because this is only correct. Presentation should be correct only. So of course ICAI will understand this, and ICAI will 100% correct this point in their next solution. Understood? So this should be 80,000. This point have you understood? But whether this is correct method, whether you should take fair value of INA including goodwill, just try to understand. In this we have adopted fair value of NCI method. Means fair value method we have adopted. But suppose you have adopted Pasina proportionate share in INA method, and if you don't know this concept, you will take 7,05,000 into proportionate share, which will be 100% wrong. In that case, your answer, whatever you are calculating for goodwill or gain on bargain purchase, that will be not correct, because in that case NCI should be measured by using proportionate share in INA excluding goodwill. Then you should do this only. Means what I want to say, just try to understand. If goodwill is given in the balance sheet of subsidiary company, if you are using fair value method, if you are using Pasina method, Pasina means proportionate share in INA method, correct? In this case NCI is measured at fair value, correct? Ultimately, correct? And if you have taken fair value of INA including goodwill, this will not affect your solution. Am I right or not? This will not affect goodwill or gain on bargain purchase calculation. So whatever goodwill or gain on bargain purchase you have calculated, plus minus goodwill whatever is given in the balance sheet, ultimately your answer remains same. But in this case NCI is measured by using proportionate share method. Means what you have done, fair value of INA, यहाँ पे क्या किया, fair value of INA multiply by proportionate share. So this will be wrong. If this is wrong, then your goodwill or gain on bargain purchase whatever you have calculated, that is also wrong. So if suppose they have asked the similar question with measurement of NCI by using Pasina method, and if you have taken fair value of INA including goodwill, then your answer is wrong. That I just want to inform you, correct? So the concept is what try to understand concept. Is suppose in your exam they have given proportionate share in INA method for NCI. If you don't know this concept, then your answer will be wrong. So be careful. I will say always do this only. You'll never do mistake. You'll never do mistake. First point, have you understood this point? This point have you understood? Yes sir. Now coming to one more point. Just try to understand. One more doubt will come. Doubt will come, sir, final dividend was paid at a rate of 10%. So can you say on this date, because there is a significant influence, so we need to apply equity method. Equity method. Now what is equity method? Equity method means what? Cost price plus share in profit minus dividend received. Now sharing profit calculation we do at year end. So because step acquisition was done during the year, so of course there is no need to add sharing profit, because sharing profit can be calculated only when the total profit is calculated. Understood what I am saying? Are you able to understand? Because that profit will be allocated as per ownership ratio, that is 40%. But right now we don't know what is the total profit, so we cannot allocate this. And we will not do on time ratio basis. We will not do on time ratio basis because practically the sharing profit is calculated at year end. So this is not required because the equity method was discontinued on this date, but dividend was received. So if you have received dividend, so as per equity method, can you see that is deducted from the cost price of investment? So 50,000 into 40%. So how much dividend received? So 20,000 will be this. It means the carrying amount should be how much? Carrying amount should be how much? 2,20,000. Carrying amount should be 2,20,000. Yes or no? So suppose if you are applying this concept, let's see what will happen. Suppose you are conceptually strong, so of course you will do in this way. The carrying amount of investment on the date of acquisition means when the control is obtained is 2,20,000, but your answer once again will remain same, because what will happen? Just try to understand. If you have done this, so this is 2,20,000. This will be also 2,20,000. Ultimately, there is no gain or loss, but 20,000 whatever has been received by parent company should be eliminated from retained earning. So from retained earning will not deduct remeasurement loss, but will deduct dividend received. Dividend received, because as per equity method, the journal entry is what? As per equity method, journal entry is what? Bank account debit to investment. But in their standalone financial statement, they have done bank account debit to PL. So of course we need to nullify that dividend because we have applied equity method. So from retained earning, 20,000 deduct. Ultimately your answer remains same. But if you are conceptually strong, you may think about this, ki why sir dividend received, that journal entry has not been done. So I am just informing you ki even though you have done that, your answer remains same, your ultimate answer remains same. So you can ignore this. You can ignore this, and if you have applied also, nothing to worry, your answer is coming same. Understood this point? But be careful about sharing profit. Sharing profit is always calculated at year end when the total profit is calculated. But on the date of acquisition, when control was obtained, that time we don't know the total profit, so that allocation cannot be done practically also. That allocation cannot be done practically also. Understood what I am saying? This point I have understood. So first, goodwill wala point you have understood. Second, equity method wala point you have understood. Third, one more point, ki suppose sir we would have assumed this, if final dividend was paid at a rate of 10%, final dividend was paid at a rate of 10%, in this case what you would have done? So simply you have deducted abhi right now 50,000 from date of acquisition. That time you would have deducted from post acquisition profit, from post, so you deduct from this. Or if you are not deducting from this, means, are you getting? Then when you are calculating retained earning and NCI, that term deduct minus dividend received, ultimately your answer will remain same. Correct now? So in our class I have given for dividend paid after acquisition date two methods. Either you deduct from this profit, post acquisition profit, or you can also deduct share of dividend from retained earning and NCI when you are doing working note of other equity. Both will give similar answer, but just try to understand. In this case what we have done, dividend received, dividend paid before the date of acquisition, therefore deducted from date of acquisition column. If suppose you have taken assumption that dividend was paid after the date of acquisition, so that will reduce the net asset after the date of acquisition to deduct from what? Post acquisition profit. Understood? This is the only concept. I hope all the points you have understood. So there were 3 points where there was a doubt. First was goodwill, you have understood. Second, dividend paid, you have understood. So dividend paid initially I have done as per ICAI solution. So they have taken this assumption. I have also taken this assumption now. However, in my previous solution, I have taken this assumption. It was paid after the date of acquisition, that when the control was obtained. And one more about the equity method also you have understood that. What about this dividend received? So ICAI has totally ignored this dividend received. From my point of view, dividend received should be adjusted, because in consolidated financial statement means whenever there is a significant influence, whenever we have an associate, so in CFS we apply what? In CFS we apply what? Equity method. So of course up to this they should also prepare CFS. So you could have done that. But normally what happens, we are preparing from SFS, CFS. So taking entire effect, we have ignored it. So ultimately the effect remains same, and therefore ICAI has ignored that. You can also ignore that from examination point of view. Bonus share you have understood. One more bonus here. So I will say bonus shares, if the journal entry has not been done, totally ignore it. Totally ignore it. ICAI has done one Jana entry. Jana reserve account debit. Jana reserve account debit to equity share capital. So they have reduced Jana reserve and then they have added equity share capital. They have added equity share capital. Means they have not added equity share capital in the calculation of goodwill or gain or bargain purchase. They have also taken that bonus shares, which is nothing but ultimately part of equity share capital. If the Jana entry has been done, then what you would have done? Suppose the Jana entry has been done, then you will add back यहाँ पर. Means you have nullified. When you are adding back, you are nullifying, and also deduct. I will say deduct from this because this will be after bonus years. So I will say make it before bonus years. 1 second, you have nullified the effect. So I will say if the bonus year journal entry has been done now, so nullify the effect, nullify the entire effect, and then do nothing. So add back journal reserve, add back that amount in journal reserve. And in equity share capital, because that equity share capital will be after bonus share, because the Jana entry has been done, deduct bonus share from the equity share capital. It means entire effect will be nullified, and then do consolidation adjustment. Understood this point? I hope now you have understood the entire solution. Got this point? So for this video, this much only. In the next video, we'll meet with some other question. I hope you have understood it. If you have understood it, just press the like button, subscribe the channel if you are new to this channel, and keep watching the video, keep studying. All the best for your preparation. Bye bye. All the best.